Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Wednesday, the 22nd of February. I'm Daniel Lam, your host for the podcast. The going is getting tough, and hopefully the tough can get going. Yes, I'm trying to console myself because of my recent bad results at chess, but this is also applicable to the current investment environment. Markets were in correction mode overnight, with PMI figures generally beating expectations across the globe, including the US. This is part of a strong set of economic data which raises the likelihood that monetary policies will be restrictive for longer, which means bad news for financial assets. Now, today I want to take a look at the information from the equity derivatives market. And of course, equity derivatives is very close to heart because I've spent most of my career being an equity derivative strategist. Well, this nervousness in a potentially more hawkish Fed has led to some investors positioning for a rise in volatility. For example, the buying of call options on the S&P 500 volatility index, i.e. the VIX index, has reached post-pandemic highs. Essentially, these investors are expressing the view that VIX or volatility is likely to go higher. Now, dealers having sold such call options to investors would need to hedge out their positions by taking the opposite position, because dealers capture the spread and they're not supposed to be putting on directional trades. Hence, they would be shorting VIX futures to neutralize their exposure. However, if there were to be a sharp spike in the VIX index, these dealers would need to cover their positions by buying back these shorts, leading to exacerbation of market volatility as the market gets more volatile. So, what are the tipping factors that may lead to this initial spike in the VIX index that would act as a catalyst for the dealers to exacerbate volatility further? Well, currently, retail investors in the US are counterbalancing short equity positions from hedge funds. This has led to lower realized volatility, which would in turn lead to volatility targeting systematic funds to up their equity exposure, which would go to suppress equity volatility. So any negative tilt to the current narrative may lead to unwinding of these dynamics and tipping the scale in favor of the bears. And we are starting to see the first signs of market stress coming back, with S&P 500 breaking below a support level at 4,015 overnight. So, once again, stay safe as we've been talking since 2023, and look to rotate some of your exposure from US equities into high-quality fixed income. Now, looking at the bonds market, US 10-year yield has broken above the key resistance level at 3.9 and likely to be testing 4% soon. Attractive yields is becoming a good reason to add to fixed income positions for those with a medium to long-term horizon. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.